All right, folks, we're going to make one video for 11.3 notes and work together. We're talking about treasury stock and some dividends. Remember what we want to do with some of these purchasing and selling of capital stock from other corporations. And so we're going to have three entries. We're going to have an entry to a thing called marketable securities where we keep track of money we have that we don't know what to do with yet or we're not investing yet. We'll invest it into another company's stock, invest in the market. And then, so we'll have a transaction to record the investment called marketable securities. We'll have a transaction to record any dividends we might get from that. And we will credit an account called dividend revenue to increase that and show that that is the revenue from dividend. And then we will sell back the stock when we're ready to use our money, get our money back. And nothing's for sure, but we would hopefully make a gain. And we would have a gain on sale of investments, which is a credit balance, but you might have a loss, which then would be a debit. They don't show you that, but and then we credit back the marketable securities that we started with. So we'll kind of show you all those things. Basic ideas, little backdrop here. Corporation earns net income usually generates a positive cash flow, meaning we're doing well. We have more money than bills. We have some extra money laying around. For whatever reason, we want to have a little bit of a plan on what to do if this happens. Alternative use of the cash would be investing back into the business, buying infrastructure, technology, transportation, adding on, fixing things, whatever the case may be, paying a dividend of some sort to our stockholders, reduce liability, paying off some debt. Those are things we can do with cash, but we can also do something where we put the money in the bank, or we can temporarily invest in capital stock of other corporations. So that's what we're just showing you what to do. You don't really need transactions put in the bank. So first, purchasing a marketable security. Marketable security is a new account. It is going to be a current asset account that has a normal debit balance. We use marketable securities for short-term investments and investment securities for long-term. But marketable securities, when we decide to take this extra money and purchase capital stock from another corporation, we will debit market securities, as you can see here. Okay. If we were doing a long-term investment where they told us in the instructions it was going to be over a year or more, then we would do investment securities as our long-term investment. Okay, so the scenario here is we have excess money and we decide we're going to put some money into Ellisville Steel. So on the 23rd, we purchased 2,000 shares of Ellisville Steel at the current market price of $26 per share. They give you the number, otherwise you take 2,000 times 26. You can see the T account there, increasing the new account marketable securities and crediting cash because we're paying that money out. But this is a good thing. We're trying to invest some money and increase our cash. So first we got to put it in. Hopefully we pick the right stock. Nothing's guaranteed. But that is the transaction, debiting marketable securities for the amount, crediting cash of the stock that we buy. It talks about it here. You can look through that at a different time. Now, as we go through and invest in this company, whether it be 2, 3, 4, 7, 8, 9 months, whatever the case may be, we might receive a dividend during this time because we are owners of this capital stock. Dividends earned on a marketable security are going to be recorded in dividend revenue, which has a credit balance, just like other revenue accounts. All right. What we will be crediting is dividend revenue and debiting cash, and you'll write it in the cash receipts journal, obviously. So in this situation, Forest Equipment received 14 cents per share dividend on 2,000 shares, so you would multiply these, and you come up with you made $280. All right, not too bad. Nothing fancy, made a little bit of money. Probably wanted to make more, but you didn't lose. So that is what we'll do when we declare a dividend. Dividend revenue and then cash debit. The last part, so we now know how to buy a marketable security. We buy this capital stock of another company. We debit marketable securities. We declare a dividend on this. We will credit dividend revenue. And then selling the marketable security. So after 6, 7, 8, 9 months, whatever the case may be, we decide we're going to sell it because now we're ready for the expansion, for the use of that money in whatever way that we wanted to. Maybe we were just ahead of schedule. So we're ready to make a sale. They say if there's a gain on these investments, we will have the account called gain on investments, which is increased with the credit. If there was a loss of sale investments, it would be a debit. They don't show us that example. So for our purposes, we're just worried about the gain of investments here, which would be a credit. Okay, the credit to marketable securities is the original price of the stock, kind of like what we talked about with treasury stock, the original price. Market securities will be credited for the original price. So as you see up here, we debited market security for $52,000. When we sell it, we will credit it. That gets the marketable securities back to zero. Okay. When we are told what the item is that we sold, how much of the capital stock we sold, it says we sold the investment for 2,000 shares at $27.20 per share. $54,000 is what we made. For $54,400 is what we're receiving. We're not making. That's what we're receiving. So when we debit marketable securities cash debit for $54,400, we know we're crediting marketable securities for our original investment amount. This is larger, so that is a revenue increase or a gain on sale increase of $2,400, and we will credit that sale. If the cash amount was lower than the original amount that we invested, this would say a loss, and we would then debit it. It'd say loss of sale investments, and we would debit it. So that debits equal credits. You can see how the new balance for marketable securities is at even. We got the gain, so that's a good thing. So those are the three entries. Purchasing a security, recording a dividend revenue for making money during the security purchase, and then selling it back, crediting gain on sales investment, or debiting loss on sale investment. The rest of this is kind of just, that's one of those things we don't worry about. That's one of those things we don't worry about. And then there's a definition you might see later called stock split. You can read about it, but dividing a share of stock into a larger number of shares is called stock split. There's more to that, but with the time crunch we have, we're not diving into it. That's all you need to know. So then, for the assignment, we got a screenshot of the instructions, so I don't have to flip back and forth on you all the time. I'm going to move this up a little bit. What we have here is it says journalize each transaction where ML Industries decided to purchase some Rowan Company investments. All right. So the first one says February 8th, MLP purchased 3,000 shares of Rowan Construction or Corporation, $16.80 per share, $50,400. So they give us the amount. We don't have to do any multiplying. And it's February 8th, check number 258. So February 8th is our date. February 8th, we are purchasing with our extra money that we're not using anything. We said 258. A marketable security is going to be debited for the amount, which we decided was $50,400. $50,400. And we wrote a check for that, and now we own $50,400 worth of stock of Rowan Corporation. Okay? All right. Next, it says we received on April 2nd 12 cents per share cash dividend from this corporation, $360. So they tell us, otherwise you would multiply 12 cents times 3,000. But we get $360 dividend, and this is on April 2nd. So on APR period, nope, not two. That didn't let me, okay. April 2nd, we have a dividend revenue. This was a receipt, and the receipt was $322. And the dividend revenue is all we're doing. When we increase revenue by that amount, it's at $360 at 12 cents a share. We then have the cash debit that we increased. So we increased cash, we increased the dividend revenue, that money that we made on this marketable security we purchased. That's transaction 2. Transaction 3, June 13th, MLP sold 3,000 shares of Rowan Corporation, $19.40 per share. So you know it went up. So that's a gain. We got money of $58,200. And we know we invested 50, so we know we're going up. So we know we have a gain on, it's a June 13th, and this is remember, we have to debit the market security when we purchase it, and we have to credit and get it off the books for that amount in the general credit. It told us we have $58,200 that's being deposited. $58,200. So 58,200 minus 50,400 will equal the gain on sale of investments. And the gain is credit, is 7,800. And again, this is the difference between the money we made and our original investment. We subtract that, that is a gain since it's positive. If it was negative, we would have a loss, and we would debit it. That is your 3 transactions, and that is the notes and work together for 11.3.